Hello everyone, this is Professor Kent. Today's recording is to take up some of the homework for chapter 8. In chapter 8, what we are doing is we are learned quite a few things, and then we're going to do some of the questions, and these questions will help you understand the material. And the first topic is superficial losses for individuals. When you do that, before we read the questions, the question is asking what are the income tax consequences for these two transactions. So when you look at these two transactions, we could be buying and we could be selling. And before we wanted to know, we needed to determine if there's a superficial loss. You must answer three questions. There's three questions that you have to answer, and your answer has to be yes to this. My first one was there a disposition of non-depreciable capital property? Property that resulted in capital loss. That resulted in capital loss. Now, of course, we're selling shares. If you're selling shares, they're non-depreciable property. We want to know if there's a loss. So we could be buying it at less price. We're buying it more and selling it less. That's what happened. My second question was the same property purchased in the period, again this is in your book, period that began 30 days before the disposition. And that ended 30 days after disposition. Now the third one is on the 30th day after the disposition, did the individual still own the property? So when that happens, you needed to have all yeses before you could do anything. So let's read the question and see. So it's, in this case, the Miss Nadia owns 1,000 shares, and the ACB is 23. On August 31st, 2024, she sells all the shares at 14.50. So there is a loss. On August 25th, she purchased 60 of these shares. So she's selling it. She purchased it, then she sold it, but she still owns some of the shares. She did not sell everything. She sold only 60%. And how did I get the 60%? She had 1,000 shares. She sold 600. She sold 60% of the shares. That's how we got it. So now, is this a dispersed property? Yes, they own 30 days. Same property purchase in the period that began 30 days before the disposition, and we also still own after the 30 days after the disposition. So when you do that, what is my proceeds? My proceeds is 600 shares. When you were to do that, like now, what they said is, Miss Nadia, what happens is owned. If I were to do that, the 100% of it, my proceeds, if I was 1,000, but we did not sell everything, we only sold. What we did is she sold and she purchased the same share within the 30 days. So that's what happened. So my proceed will be 14.50. That's what the selling price is, 14,500. And then what we have is we have an ACB on the 1,000 shares, which ACB was 23, and that is my 23. So now what we have is there is a loss, and some of the loss is a superficial loss. How much my loss is? My loss is 8,500. Now we repurchase the same shares at the cost of 37.50. So this loss, not the whole loss, some losses are superficial, and when you look at for superficial loss, you take 8,500 multiply by the 60% because we repurchase 600 right away, and that is my 5,100. My capital loss is only going to be the difference between the both, which is your 3,400, and taxable capital loss in this case will be half of that. I multiply by half of that. That will be your minus 1,700. That will be your we call it allowable capital loss. Now when you think of it, what is the ACB of the 600 units that we still 600 shares that we still have? So when you talk about that, we have a cost will be your 600 multiplied by the 1375. That's the purchase price, which is the 8,250, and we have to add back the superficial loss to becomes your superficial loss, and that was my the 5,100. So this becomes the ACB for the 600 shares that we have in our books. So 350. So that will be my ACB. Going to the next question, we have a capital gain reserve. When does this capital gain reserve happens? This happens when you sell a property, and that property you're not getting everything back from, you're not getting all the money from the customer. So when that happens, you have to calculate the reserves. So we have to do it for 24 and 25. So let's look at it and see what happens. So in this case, we have ACB, and we have something called a cost. So ACB is the cost, and then we have something called proceeds. So difference between the both will be my capital gain. So what happens? The ACB is 293, and then my proceeds of disposition, proceeds of disposition is, in this case, what happens is that we sold 382, and I'm putting it in the wrong place. So my proceeds of disposition is 382, but we also paid some selling costs. So 17,200 becomes my cost. So in order for me to do a capital gain, or of course we sold it for more, we have a capital gain. My capital gain is difference between the both number, which is 71,800. So what happens is if we needed to know, did we receive all the money from the person who we sold it to them? So no, we did not receive it. How much we did? So in this case, in the year of sale, he receives only a down payment of 82,000, and the balance is 30,000. The note is to be repaid in the rate of 60,000 per year, starting with year 2025. When you do a reserve, we look at my capital gain. So what is my capital gain here? 71,800. And what we're doing is we have to take that number, and then what we have to do is multiply by what means. If you look at it, we sold our property was 382. They give us the cash payment of 82. So not yet paid, which is 300,000. So you're going to say 300,000 divided by my total amount that we sold the property at. So 382. So this, what happens is, this becomes your reserve. So then what we also have to do is, now how long we're gonna take us to pay. They said that it's gonna take us 5 years to pay, but when you do this in a formula, you're going to take your 7,800, multiply by the 20%, and then you have 4 minus 0, and my reserve here, I'm just trying 57,440, and it is 56,387. These are my reserves. So when you have a reserve, what we're going to do is we take the lower amount. So when you do that, this is the lower, then we take the lower reserve. So is this person's Miss Gary's, if we were to do a taxable capital gain, his taxable capital gain will be, so this is the lesser of the both. The capital gain was his taxable capital gain will be, 71,800 multiplied by the half in order to get a taxable capital gain. And then what we're going to do is minus, I'm just going to use my phone to calculate my numbers. 71,800 basic 70 multiplied by 1 divided by 2. So my taxable capital gain becomes your my taxable capital gain becomes 35,900. And what we're going to do is from the, you could do both in the same time, or you could do it all together. So what we're going to do is your taxable capital gain, what it becomes is half of that. So there's a different way of doing it. I was going to do it the longer way, but there's a shortcut. So half of my capital gain, which is 17,800, and my reserve here was 56,387. In 2024, I will be paying taxes on 7707. So that will be my gain. I will be including it into my income. That's what happens when you this will be added. So that's what happens, and this becomes my reserve. And what we do is we pay taxes on 7707. Now whatever our reserve was, we needed to add back. So this reserve is deducted, and then what we do is when you come into 2025, and what we're going to do is we have to the following year you have to add back the reserve. In 2025, what we're going to do is we are going to add back what we deducted, 56,387. We deducted it. Now we're going to be adding it. That's the first thing you're going to do. We also have to pay we also have to pay some capital gain, but we have to calculate it. Your reserve for this 2025 will be lesser of the two numbers. My first number was 71,800. That was my capital gain, not yet to due. So what happens is we not yet to due. They made another payment. How we're going to do it? They owed us 300,000. They paid another payment of 660,000 divided by the 382, and my reserve becomes 45,110. And then what we have to do is we have 71,800 multiplied by the 20%. Now 1 year has gone by, and that will give me 43,080. Lesser of those two is 43080. So when you do that, now my reserves, I add back 56,387, and what we're going to do is this is the lesser reserve that we're allowed to deduct. And what happens is that will be we will have a capital gain, and that will be my capital gain for the year 2025 will be 31337, and half of that will be my taxable in case and the question asks for your taxable capital gain. So this is my capital gain. We only pay taxes on the taxable. Half of that will be 6654 will be the amount that we will be paying taxes on. Now going further, we're going to do this question. What happens in this question is we have a sale of a principal residence. That's what happens when you own more than one property. What happens is wherever the higher gain is, that's what we wanted to make a principal residence. The other property we wanted to make it as a because if it's a principal residence, we don't pay taxes on the capital gain. If it's a other than the principal residence, we pay taxes on that capital gain. So what we have is we have a sale price, or we said and we have an ACB, and what we have is we have a cottage and we have a house. So we call it a house. So we have a house and we have a cottage. So when are we doing this? We're doing it in June. So we have we're doing this in 2024. So she purchased the house in 2013, and of course we own it 13 and we're in 2024. House was owned for 12 years. And when the cottage was purchased in 16, and this one was owned for 9 years. So my sale, they said she purchased the house for 126, so that's the ACB, and the cottage was gifted to her by her parents. The fair market value of that was 85, so that becomes the cost, 85,000. And we sold this for 698, and we sold this for 343,500. We have a total capital gain, and what happens is this case we have a higher capital gain on the house, and we have a lower capital gain on the cottage. We wanted to make this a principal residence. So when you do that, what you have to do is we have to calculate the average annual return first. The first thing you're going to do is average annual gain. Annual gain on the first one, 572 divided by the number of years that was owned, that is 12. My average gain on my annual gain on my cottage is my 258,500, and that will be divided by 9, 47,667 and 28,722. When that happens, what we needed to do is we needed to use a formula, and then that formula is we wanted to do, in this case we are making this as we won't pay any taxes on this. We wanted to pay taxes on the gain that we have on the property that has a less gain. So multiply by 1 plus the 1 divided by the 9. 9 came from the property owner, and then what happens is that we have a reduction in, this is called a reduction in a gain. And how much the reduction, because 1 year we owned both properties, so this is where 1 plus 1 comes from. And then what happens is what will be my capital gain. So in this case the capital gain will be, I have 258,500. that's what my capital gain was. And what we're going to do is we add we are going to do my reduction first. Let's do my reduction, and then what we're going to do is my reduction was 57,444, and then we have a capital gain. we supposed to pay taxes, but we're not paying taxes because this is my principal residence. So this becomes your capital gain. My capital gain amount will be 201 0.056. So this is what we the capital gain we will have. So in other words, we pay the taxes on a taxable capital gain, which will be house, which will be half of that. This is my last question, and what we have is we have a personal use property. When you have a personal use property and listed property, and we want to know what are the consequences. So personal use property, and we have a listed personal property. So first one is we have a, what we have is you have a sailboat, and if it's a sailboat, it will be personal use property. The selling price is 68,000 and the adjusted cost base is 43,000. Difference between those is 25,000. Now this is a gain on a sailboat. Seems like we also have a gain on oil painting. When you do that, it is a it will be listed personal use property. We sold it for 25,000, and under the listed and the personal use property, the cost cannot be lower than the 1,000. So that will be 20,000, and then it will go under here. That is my 24,000. So now what we have is we have a personal automobile, which will be personal use property, and seems like there is a loss, and that loss is we are not allowed to. We have a loss on personal automobile, and that will be nil. We're not allowed to do a loss. But if it's a listed personal use property, we're allowed to carry forward the loss. We're not allowed to we're allowed to carry forward the loss. And loss on necklace, we have cost was 46,000 minus the 18,000, and what is that? Difference between those two is my 28,000, and that is my loss. So in my gain is, in this case, my gain is 24, my loss is that. So what we have is we have a loss of 4,000, but we can carry forward this loss. We're not allowed. That will my capital gain from this will be 0, and the capital gain from your other one will be 25,000, and what we get, that's a capital gain, and we are going to pay taxes on the half, and the half will be your 12,500. And what is that called? Taxable capital gain. This 4,000, if we call it, it's a carry forward for the future year. So that is a carry forward for the future year. This was chapter 8, some of the questions from chapter 8. Thank you so much for listening to me. Thank you for subscribing to my channel. Please, if you haven't subscribed it, please don't forget to subscribe to my channel. That way you get my new videos. I try to post as many I can during after the class. Sometimes I don't get chance to do that. Please be patient for me to record the video and upload it to my channel. Thank you so much for listening to me. Take care and bye for now.